Welcome, everyone. We are pleased that you have joined us for today's webinar titled Section 1035 Exchanges, Tax Ambiguities, and Processing Disasters. The webinar will last approximately 15 minutes, and at the end, you will be given an opportunity to receive supporting materials by email free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Jennifer Lawler. Jennifer joined the Advanced Underwriting team in October 2014. Before joining the team, she spent 6 years working for a tax and estate planning group. While there, she worked extensively on tax return prep, estate planning, and assisting clients with their tax needs. She will draw on her legal, life insurance, and practical experience for today's webinar. And here she is.
Hello, everyone, and thanks for joining us. Today we will be talking about Section 1035 exchanges, tax ambiguities, and disasters. Section 1035 of the Internal Revenue Code is an important one for life insurance professionals. It enables an individual to trade one life insurance policy for another without an immediate income tax result. Section 1035 provides that with certain exchanges of insurance policies, no gain or loss shall be recognized on the exchange of a life contract for another life contract, or an endowment or annuity contract, or for a long-term care contract. Section 1035 exchanges can be incredibly valuable tools when used correctly. There are several reasons one might consider utilizing a Section 1035 exchange. Among the most popular reasons are that a new policy provides better benefits or investments than an existing one, or if the cost to maintain a new policy is lower than that for an existing policy, or if the new policy is more suited to the client's investment philosophy or insurance needs than an existing policy. The code that I read earlier seems deceptively simple. Exchange one policy for another without tax consequences seems fairly straightforward, but there are several potential traps for the unwary that can result in disastrous tax consequences, such as failing to follow the required steps properly, attempting to complete an unapproved exchange, or ignoring special rules. Failing to address the processing nuances of the carriers involved can cause big problems, as we will see later in a case we will discuss. But possibly the biggest Section 1035 trap is the consequence of taxable boot. Subparagraph C of Section 1035 sheds some light on this problem. It reads, in short, that when a 1035 exchange occurs that consists of more than just the contract exchanged, meaning that it includes other property or money, to reference Sections 1031B and C. When we look to Section 1031B, we find that when an exchange occurs that consists of something more than just the underlying contract, then the gain, if any, to the recipient shall be recognized in an amount not in excess of the sum of such money. What do these pieces of code mean when put together? In short, if a life insurance policy has an existing loan against it at the time of its exchange, and the new policy does not, the loan balance is treated as taxable boot at the time of the exchange. Boot is taxable on a gain-first basis. As you can see, exchanging a life policy with an existing loan for one without a loan can create a tax surprise for the uninformed. But how can this be avoided? There are a few options. The most obvious option is for the policyholder to pay off the existing loan before the exchange, but some folks have taken large loans without the intention of ever paying those loans back. If that is the case, loan rescue may be an option. Loan rescue generally allows a taxpayer to exchange a policy with an outstanding loan for a new policy subject to a loan at least as large as the original policy's loan. Finally, some taxpayers with large outstanding loans may be able to take advantage of reduced paid-up insurance. And we're going to discuss all of these options. Two private letter rulings open the door for loan rescue programs. Following the logic of these private letter rulings, where a life policy with an outstanding loan is exchanged for another policy subject to a loan at least as large as the original policy's loan, the exchange will be treated as a tax-free exchange. Over time, the policy owner would use cash value or paid-up addition withdrawals to pay off all or some of the loan balance and improve the long-term economic position of the policy. Loan rescue programs are not as popular as they once were because they require substantially more paperwork for carriers and a lot of flexibility post-exchange to accommodate loan balances that were lower or higher than expected. As loan rescue programs became less popular, taxpayers and agents sought ways to duplicate the results of loan rescue without a carrier's active involvement. Private letter ruling 9141025 illustrates a proposed manual loan rescue. The taxpayer in this case owned a life policy with $1 million in basis. The policy also had an outstanding loan worth $448,000. The taxpayer wanted to take a partial withdrawal from the policy to be used to pay off the loan. The taxpayer expected to treat the partial withdrawal as a tax-free return of premium. He would then exchange the remaining cash value for a new policy and treat it as a tax-free Section 1035 exchange. However, the IRS held that this would result in the application of the step transaction doctrine. The step transaction doctrine combines a series of separate steps into a single integrated event. Because the IRS viewed the actions as part of one step, the actions proposed by the taxpayer would result in taxable boot equal to the extinguished loan. The IRS never said how long a taxpayer would have to wait between steps in order to avoid the step transaction doctrine. Some carriers impose an arbitrary 6-month time frame, but the IRS has never said for certain. If the taxpayer cannot repay the loan and there are no loan rescue programs available, what can be done? Reduced paid-up insurance may be an option. Say the policy owner has a whole life policy that they've taken loans from, and that because of the loan's interest, the policy is in danger of lapsing. If the policy has a provision that allows the option to change coverage to reduce paid-up insurance, the policy owner may be saved. Under a reduced paid-up provision, the carrier will generally replace the client's current coverage with an amount of life insurance guaranteed to stay in force until death. The amount of paid-up insurance is usually based on the net surrender value of the underlying contract, the policy's cash value minus any loan. Some experts argue that the election of reduced paid-up insurance is a continuation of the underlying coverage, while others argue that the election is enough like a Section 1035 exchange that the loan should be treated as taxable boot. Which view is correct? We don't know. The IRS has never told us. But reduced paid-up insurance is worth considering if the policy will otherwise lapse. Now, as we mentioned earlier, processing Section 1035 exchanges can involve a tremendous amount of paperwork and active involvement by multiple parties. If one party should fail to follow up or do their part, the exchange can fail completely. A recent decision in the Sixth Circuit Federal Court of Appeals illustrates how a breakdown in the processing phase can cause big problems for the taxpayer and the carrier. In Branch Banking and Trust versus Pacific Life, a miscommunication during processing resulted in costly litigation. In the case of Branch Banking, the trust officer of an irrevocable life insurance trust sought to exchange a trust-owned Pacific Life variable life policy for new coverage by John Hancock via a Section 1035 exchange. On September 8, 2008, John Hancock sent a request to Pacific Life and attached a copy of a Section 1035 assignment form as proof of John Hancock's ownership and authority to request surrender and receive the proceeds. Pacific Life received the surrender request on September 9, 2008. On that day, the policy's cash value was about $780,000. A Pacific Life employee received John Hancock's request and treated it as a typical 1035 exchange. But because she did not have the trust officer's signature on file and the signature on the request had neither a notarization nor a corporate seal, she decided that the assignment was not satisfactory. She stopped the process of surrendering the policy. She then sent 2 letters by regular mail. The first letter was sent to the trust officer informing him that she had received the request, but not mentioning that the process had been stopped. The second letter was sent to John Hancock, advising them that the request would not be processed until Pacific Life received an acceptably authenticated signature. Branch banking was unaware of and remained unaware of the demand for additional authentication for 3 weeks. During this time, the stock market crashed. By the time the trust officer was made aware of the mistake, the policy's cash value was $56,000 less than its September 9th value. The bank asked that Pacific Life facilitate the exchange using the September 9th value, but Pacific Life refused. Eventually, on December 11, 2008, 2 months later, the bank's trust officer sent a new request with a notarized signature and corporate seal, while also reserving its right to sue for the difference in cash value. Pacific Life executed the exchange the very next day. The policy's cash value on that day was nearly $260,000 less than its September 9th value. Branch banking sued for breach of contract on the theory that the policy required Pacific Life to send to the trustee notice of Pacific Life's rejection of the Section 1035 paperwork. The case was ultimately decided by a jury that found that Pacific Life's refusal to process the Section 1035 exchange on September 9th was unreasonable. It awarded damages to the islet for the nearly $260,000 of account value lost while the exchange was in limbo. Pacific Life appealed the case, but the Sixth Circuit affirmed the result. This case shows us that complications can arise during a Section 1035 exchange involving multiple parties. An employee's decision that the paperwork was lacking cost the policy owner more than $250,000 and the expense and headache of a lawsuit. When a Section 1035 exchange case is submitted, extra documentation is often required to follow up. The extra processing and multiple employees and multiple home offices can often lead to communication breakdowns and confusion and delay. In the branch case, one employee's decision completely halted the process, and that delay led to a loss of more than $250,000 in cash value, not to mention the cost of the suit. The facts of this case should remind professional agents about the importance of taking the time to identify all of the paperwork required to submit a case, to accurately and completely provide all needed information, to secure all signatures required, to read the carrier's directions, to be sure all formalities are strictly followed, and to follow up and stay with the exchange process until it is completed. Another takeaway from this case is that if the client is in the process of exchanging a variable life policy for another policy with less investment risk, consider moving the variable account balance to the least risky investment choice prior to starting the exchange. If that had occurred in this case, it might have saved some money. Section 1035 exchanges allow taxpayers to avoid recognizing an income tax result when they exchange one insurance policy for another. While the concept seems simple, complications can and often do arise. Advisors should always work with the client's tax professional to make sure they understand the potential consequences of an exchange with inherent tax risks. Communicate as actively as possible with those processing the Section 1035 exchange paperwork so that any roadblocks will be dealt with quickly. Complications aside, Section 1035 exchanges are still a great tax-saving opportunity for clients to trade an underperforming or unneeded insurance policy for another. Thanks for listening in today.
Alrighty, thank you, Jennifer, and thank you everybody for joining us today. As a reminder, if you want to receive supporting materials, please email us at asktheexpert@advancedunderwriting.com. And you may also email questions related to today's webinar. And for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact me, Lisa, at 615-224-1291. Thanks again, and best wishes for continued success.